Hello, Navid.
Hello, Ali. How are you?
I'm good. Thank you. Hello, everyone, and welcome to the fourth episode of the AlgoCat Overthinking Cats. And today we want to wrap up the TFSA questions from last time. If you missed our last episode, we discussed what's the TFSA and we gathered lots of information about that. And by wrapping up TFSA, we want to also dive a bit deeper into other registered accounts like RRSP and FHSA and some of the others. And hopefully, we finalize the first section of our syllabus.
All right. Cool. Let's get started.
Okay, so last time we went through these questions for TFSA, and this time we have these questions remaining. So starting from here, what are the contribution rooms affected by? So I suggest we search this. Do you have any other suggestion, Navid?
Like we usually put the prompt into Claude, right? I
Yeah,
suggest
I think we previously did this even.
Okay, so
Okay. So
did we get our answer or we need to do it again?
I think we need to finalize this. We didn't finalize it.
Yeah, okay. We can go over it again.
Okay. So the parameters affecting contribution room is that the base contribution room starts with annual dollar amount set by the government. It was introduced in 2009, and every year it has increased with some certain extent. So your age would play a crucial role because these contribution limits accumulate year by year since the year you turn 18 or you have paid or filed taxes. So then your residency status is another parameter when you're a Canadian resident. And last time we discussed this Canadian resident, that it's when you pay taxes and you are in Canada legally.
Correct.
So if you go away from Canada during that period, with you become a non-resident, you keep your existing room, but you don't accumulate for those non-resident years. When you return back, you resume accumulating.
Okay, sounds good.
So your withdrawal history also affects it. Any amount you withdraw from your TFSA gets added back to your contribution room, but not until the next calendar year. And we discussed this last time. This creates what we might call a time-shifted resortation of your room. For instance, if you draw 20K in July 2024, that 20K gets added to your contribution room next year on January 1st. Your contribution history is also a parameter. Each contribution you make reduces your available room. Unlike withdrawals, contribution impact your room immediately. So that makes sense. Market performance of your investment within TFSA doesn't affect your contribution room. If your 10K investment grows to 15K, your contribution room isn't affected. Really? However, if you withdraw that 15K, you would get 15K in new room that the following year, effectively allowing you to shelter. So what happened here? I didn't understand.
So that means basically as long as you haven't withdraw from your account, it
Okay.
doesn't affect your contribution room, right? Um, like you have 10K in your investment and it grows to 15K, that's fine.
Mm-hmm.
As long as you didn't withdraw money, that means your contribution room won't affect.
Okay. Okay. So this was one of our other questions. Like we'll get to it. I think I might have the answer, but again, to check it, we will check it later. If this based on this, it's I understand that it says if your 10K grows to 15K, that growth isn't considered as your contribution room. That 5K, or is
Yeah,
it?
because it's still in your investment account.
Yeah.
Does that
Okay.
make sense?
But it's still, but it's in your investment account, but it is in your TFSA. What if you
Yeah.
sell your
So
stocks, you keep just the money as cash in your TFSA?
yeah, the cash is in there, and as long as you haven't withdraw the money, so basically when you deposit money into your investment account and when you withdraw money from your investment account, that would affect your contribution room. Nothing in between. Like if you put your money in your TFSA investment account and don't touch it, it won't affect your contribution room.
Okay. Okay. But if you take it out, it will. Okay.
Yeah.
Okay.
Exactly.
So moving on, unused contribution room carries forward. Over contribution works against you in two ways. It's a 1% per month penalty, and withdrawing an over contribution doesn't give you back that room next year. Sounds good. So let's move to our next question. What are the withdrawal rules? Or like, is it as simple as like just withdrawing the rules? Or let me just paste all of these questions here. So withdrawal rules, you can withdraw any amount anytime without penalty. Withdrawals are completely tax-free. The withdrawn amount gets, we know this, next January 1st next year. There's no requirement to document the reason for withdrawal. Okay, cool. So our next question, and pause me, Naveed, if you had any points at any point.
Sounds good.
Okay. So our next question is, does trading internationally affect TFSA rules? We asked this question previously, but we needed more information on like what exactly are those countries that recognize the TFSA. So we knew that US stock will have a 15% withholding tax on dividends that you cannot recover. And some other countries have other tax rates. But capital gains within Canada remains tax free, even if they're international. So you don't get taxed on the capital gain, but on dividends, which is something we're gonna learn about later, you get taxed. Right?
Yeah, I think that makes sense to me. Like as long as you are not a US citizen and you do have US stocks, and on those stocks you are getting dividends, that means there are like monthly payments or quarterly payments that you gain because you are holding those stocks. Those dividends would be taxed based on your income. So
Mm-hmm.
I think that makes sense.
Okay. So this website is discussing things that are not related to us, I think. So the IRS applies 15% tax, usually, in 30% in some cases, on dividends. So if your client invests in a stock that pays 400 dividend with 15% tax, withholding tax, it's going to be 340 deposit to their TFSA. Their client would be unable to recoup the withholding tax in the form of a foreign tax credit because no tax would be paid in Canada. If, on the other hand, your client holds the US dividend paying stocks in a non-registered account, they'll have access to a foreign tax credit. What? Sorry. Okay. Shall we move on?
Sure. So what's the next question?
So the next question is when to use versus not to use. And I have this great decision tree from Wealth Simple where it helps to decide when to use TFSA versus RRSP versus FHSA. But let's review those accounts as well and then get to this decision tree.
Sounds good.
So the next question comes.
So
yeah, go ahead.
Yeah, like how many questions do we have left?
So here we have 1, 2, 3, 4, 5 questions, and then we have some more here.
We're gonna move to RRSP. Okay.
Yes.
So, all right, sounds good. Let's speed up a little bit and try to answer this question, and then jump into RRSP.
Okay. So, can my friend contribute to my TFSA? So, the answer to this is that only you can contribute to your TFSA. If they want to give you money as some gift, they can give you the money, you can contribute. Not so it makes sense.
Correct. So they cannot contribute on your behalf.
No.
They're gonna give you the money and then you can do it yourself.
Yes. So some bank accounts offer something called GIC, which is Guaranteed Investment Certificates. And that is clearly different from TFSA because like TFSA is an account, is a registered account for taxes, and GIC is an investment product. So it's not necessarily related to investment. TFSA is not related to investment. You can hold a
you can hold like GIC in your TFSA account. That's right.
Exactly. Yeah. Okay. Interesting. So TFSA is like container, and GIC can be one thing you put on it. Okay. So let's say I need to withdraw. Is there any time or anything I can do to limit the bad effects? If possible, withdraw in December rather than January, so you don't later. Better, right? You get the contribution back
like
in
if
January.
if you withdraw in January, you need to wait until the end of the year, which is the next January, to get your contribution room back. So if you want to withdraw, usually people do withdrawals in December because it's going to be shorter for them to get their contribution room back. Like it's going to be a month instead of 12 months. Mm-hmm. So that's why it is advised to withdraw in December so that you can get your contribution room back in a month.
All right. So it also says consider withdrawing slightly more than you need if you want to recontribute soon. Do you know why is that?
I didn't pay attention. What was it?
Consider withdrawing slightly more than you need if you want to recontribute soon.
I don't know why, actually. considering withdrawal slightly more than you need if you will. Why? Like,
So while this is answering, we'll continue. Plan large withdrawals around your other financial needs and contribution plans. So like your whole big picture of your financial, and keep track of withdrawal dates to know when you'll get the room back. So it's saying, let me explain the withdrawal timing strategy in detail. So if it's an emergency fund that you'll replace quickly, you need money for short-term emergency. You expect to be able to replace it soon. A December withdrawal means you can replace it just a few weeks later. Investment timing. If you're planning to reinvest in a different opportunity, December withdrawal gives you flexibility to reinvest in January, less time out of the market. Okay, and okay, we come here. The withdrawal strategy more than you need works because if you think you might need more money soon, better to take it all at once in December. Get all the contribution room back in January, rather than making multiple withdrawals and waiting a year for each.
I think this is in like when you need the money, like so like if you are, I think the best way to say it is if you you are on profit, it's better to withdraw the money and then you can increase your contribution rule. I think that's the that would be the main reason that you want to withdraw more than what you need, just to increase your contribution room so that you can contribute back later. But still, if you don't need the money, it doesn't make sense to do that. Like you have your investment in there and it is growing. Why you need to withdraw it?
Yeah,
I don't get it.
I don't know either. Let's move on. So another thing is moving money between your TFSAs. Direct transfers between your own TFSAs. What does it say? Should be done through proper financial institution transfer procedures. Don't withdraw and recontribute yourself. So okay, there's a direct transfer or transfer in kind. So if you do direct transfer between two TFSA accounts of your own, it won't count against your contribution rule. If you withdraw that if you withdraw that money into your another bank account and then put that again into your TFSA, it's gonna affect that.
Interesting. I didn't know that actually.
Okay, so if you lose money on investments in your TFSA, you permanently lose that contribution. So for example, you contribute 10K, value drops to 5K, and you withdraw. Next year, you only get 5K in contribution room, plus the annual amount. Investment losses in TFSA can't be claimed as capital loss. So this is something we should be careful of.
I didn't know that either. Like if you lose your contribution room or if you lose in your investment, you can't use it as a like capital loss. That was interesting.
What's capital loss?
Like some accounts let you to, when you are filling your taxes, you can report capital loss so that you can reduce your like taxes, that your income taxes that you are paying to the government. So but TFSA is not like that. Like if you lost your contribution room, you cannot report capital loss on that.
Interesting. This was very interesting. Very, very interesting. So let's look at a few scenarios. You do 10K, value drops to 7K, you withdraw everything 7K, you only get 7K in contribution room. So 3K is lost permanently. So in another example, you contribute 20K, you buy stock, it drops to 15K. You sell and buy different stocks, it rises to 18K. You withdraw everything at 18K. Next January, you get back 18K. So like you don't lose the 5K, you just lose the 2K. So another scenario is you invest 10K, it grows to 15K, you withdraw nothing, suddenly the value drops to 8K, then you withdraw 8K. Even though you had 15K, the current value determines your future. So I think now it's more clear. Okay. These strategies might be interesting. We're gonna look at them probably later, but when we get into risk management strategies, but like it says use stop loss orders, something that we'll read about more later. And if an investment is dropping, consider if it's better to withdraw while value is higher and diversify your investments. Okay, with that, I think we got questions to all of our TFSA questions. Right? So shall we move on to RRSP?
Correct. Yeah, I think we can only cover RRSP, and then for next week we can jump into FHSA, and after that we're gonna move into RESP. Sure. So let's jump into RRSP now and see what is RRSP, how it works, how we can, what are the benefits of RRSP, and like all those questions that we have on top in our document.
Okay. Here are the questions. Let's go here. Okay, so RRSP is for retirement, right?
Correct.
And RRSP is tax-deferred retirement saving created by Canadian government. Tax-deferred means you... Yeah, go ahead.
Yeah, like unlike TFSA, which is tax sheltered, RRSP is tax deferred. And tax deferred is different than tax sheltered. Let's see what Claude is trying to describe, and then I'm gonna jump into and say, like, try to describe more about it.
Sure. Okay, so tax deferred, it's not tax, it says it's tax deferred. So this is a new term. It means you don't pay tax on money when you put it in, but you pay tax when you take it out. So unlike TFSA that you only put money on it, we got this question that can we ask our employer to directly put the money in RSP? The answer is no for TFSA. But for RRSP, contributions are made with pre-tax income. And it reduces your taxable income for that year until the time you take it out. So you put the money there, investment growth is in RSP tax sheltered until withdrawal. So you make a deal with government, they let you delay paying tax now in exchange for paying them later.
Yeah, and the benefit here is that you might think, what's the benefit if I don't pay the tax right now and I pay tax when I want to take the money out? So basically, when you are taking the money out of your RSP, you are retired, and as a retiree, you are paying less taxes compared to nowadays, which you, let's say, your income is 100K, your tax level is higher, and as a result, you are paying more taxes. But when you are retired, your annual income might be around 60K. So your tax bracket is lower, and you are paying less taxes. So if you take this money out, you are paying less taxes on your money.
Nice. And also, like during this time right now, your contributions, it says, reduces your taxable income for the current year as well. So your tax bracket even might change.
Yeah, like when you are filing your previous year taxes, you can say I contribute like 10K into my RRSP, and then you can get the tax benefit.
So this is exactly what you were saying. You contribute during high income years, withdraw during low income retirement years. You save tax on higher rate.
True. Yeah, exactly.
Very, very interesting. So when can I withdraw money from RSP? So it's regular retirement withdrawals after age 71. So you first need to convert RSP to another account called RRIF, with I don't know, Registered Retirement Income Fund. You need to convert this to that. By end of year, you turn 71. Required minimum withdrawals start the following year. Withdrawals are taxed as regular income. If you want to withdraw earlier, you can withdraw at any time, but there are consequences. Immediate withholding tax, depending on the amount. Amount is added to your taxable income of the year. You permanently lose the contribution room. There is a contribution room?
Wow. Yeah, for RSP as well, you have a contribution room on your notice of assessment when you file your taxes. If you pay attention, there is a number next to your RSP contribution. You cannot over contribute.
Okay. It says it's your RSP contribution limit for 2025 is 18% of the earned income that you reported on your tax return the previous year.
Yes.
Up to a maximum of something, 32K. So your financial institution must withhold tax, and the amount differs. And also Quebec residents, like, they have different rates as well. So it says, like, if you want to do something, you're saving for some specific special program, just use another account. So there is a home buyer's plan, which you borrow up to 35K tax-free for first home. Lifelong learning plan, you borrow up to 10K a year for education. Both require repayment over time to avoid tax consequences. So did we answer all the questions here for RSP? What is RSP? When can I withdraw money? What are the benefits? And what if I withdraw money before retirement? And we also answered the RSP contribution limit.
Yeah, if you have any other question regarding RSP, feel free to ask Claude, because I don't know about all those questions that you have most of the time. So do you think it was like our question was through enough for us to move on to the next section, which is our next week recording, I guess?
I think so.
Not, I think if any question is coming to your mind, feel free to share it, because we do have like around 1 or 2 minutes.
I think we're good for now. We do have one question here about RRSP. which shouldn't be down there. It should be here. So there is RRSP matching. So RRSP matching is a feature of some group retirement savings program. In a matching program, the employer matches your contribution into the plan dollar for dollar up to a certain amount. So what it means is, I think, is that so there are group RSPs, and there was an example here somewhere. So let's, for example, it could be that you save 5% of your paycheck. Also, your employer matches another 5%, and it would be a 10%, basically. So it's additional. It's out of your something else from your paycheck. Once you're enrolled, you'll agree to have a set amount of deducted from every paycheck, and your employee will match your contribution with predefined contribution of their own. And this is a some companies give this benefit, and this is different from your income. Your income paycheck is there. It's an added value.
Yeah, correct. So it's actually a good benefit if your company is offering you these kind of perks and like RSP matching, or like other some companies do other like accounts matching as well.
Mm-hmm.
You can benefit from those, and the percentage of the matching is different. Some companies offer 5%, some other more than that.
Mm-hmm.
So it depends on the company that you're working with.
Mm-hmm.
But it is so beneficial if you can use that, because basically, as as we saw in the previous example, if you contribute 5% of your paycheck, they're gonna contribute 5% back, which is actually really beneficial for employees.
Yes, exactly. Nice. So with that, I think our RRSP session comes to an end. Also TFSA. So we wrapped up TFSA RRSP. Let's look at quickly where are we at the syllabus. So at the syllabus, although it was week 1 to 2, but we are following the order, not the week exactly. So over here we know registered versus non-registered, the TFSA, the RRSP, and next time we're gonna look at FHSA and RESP and other accounts, and then we're gonna move into learning about the investing terms and tools and everything like that.
I think we do have a project in the next week 3 to 4, which is super exciting. We're gonna make our hands dirty and start a new project and see how it works. Ali has several projects idea in his mind, so stay tuned for those.
Exactly. Thank you everyone for watching. See you next week. Bye.
Thank you. Bye.